Okay, hi everyone. Welcome to today's webinar brought to you by Vantage. We're going to do Venezuela, oil, and global markets. Okay, so sorry for the slight delay. We're about 10 minutes delayed today. Sorry about that. Don't worry, we will extend 10 more minutes if you guys have the time, and also if we don't finish the topic for today. Hopefully, we do finish it. Okay, I'm gonna do a fast one so that we can actually finish. Okay, disclaimer, just a very quick one because because we've already eaten 10 minutes into our 1 hour webinar. Anything that I share with you guys in this webinar should not be construed as any form of trading advice, investment advice, or any form of signal to buy or sell. I'm not telling you to buy or sell anything. I'm not telling you any kind of advice. You are just here purely for educational purposes. This is for me to share my perspective, to share what I've researched on this topic, and well, my team have researched on this topic, and to understand the markets better. So whatever I share with you guys today hopefully helps you understand the markets a little bit better. Oh, sorry, I do have to stay here for a minute. I actually have to give you guys a bit of time to read it. So 1 minute and then we'll continue. Okay, cool. So that should be good. I'm going to introduce myself. My name is Cassandra. I see the usuals on Zoom, so you guys should be good. I'm an investment analyst and a prop trader. My job is basically to study the markets, to forecast it, and to understand where it's going. I spend a lot of time researching the markets and even today's topic, it may be 1 hour for you guys, but it was many hours for me researching this topic. Okay, I probably spent a few days researching on this topic. And not only that, the research has to be from reliable sources. It has to make sense. It has to be relevant to the trading world. Okay, so I hope you guys do take the content today home, and I hope it helps you guys view the markets in a different perspective. Okay. If you guys have any questions regarding trading or anything at all, just ask me in the chat box. Otherwise, I'm gonna continue with the agenda for today. Our agenda, the US operations in Venezuela, political and market impacts, oil supply dynamics, prices and forex correlations, geopolitics with Russia and China, strategic alliances and market risk, emerging market spillovers, currencies, bonds and risk appetite, and long-term scenarios, regime change, energy flows, and yeah, global supply chain. Sorry, I didn't put a supply chain there, but it should be global supply chain. Anyways, let's start with the first topic for today, the US operations in Venezuela, political and market impacts. How is this gonna affect the markets? Let's find out. Okay, take note, guys. I decided to go very in-depth in this topic because this is a topic that is it was an interesting topic for me as well. I purposely chose this topic because it was also a topic I wanted to know. So it can be very, very lengthy, the information I'm about to share. So hopefully you guys absorb whatever I'm going to share with you guys. But again, if you have any questions, just ask me in the chat box. Okay, so when we talk about the US operations in Venezuela, we are not talking about a minor diplomatic disagreement. We are talking about one of the most significant geopolitical events of 2026, one that has potential long-term implications for oil markets, financial markets, and the broader global economy. In early January 2026, the US forces carried out a targeted operation in Venezuela that resulted in the capture of President Nicolas Maduro, sorry. This followed a period of escalating tensions that had already included an oil blockage and sanctions aimed at crippling the Venezuelan oil sector. What makes this different from past actions is the direct kinetic involvement of US military assets and the explicit goal of reshaping control over Venezuela's oil production and fiscal revenues. Okay, now at a very basic level, Venezuela matters to markets for one reason. It's very important. It is oil. Okay, Venezuela holds the largest proven oil reserves in the world, even more than Saudi Arabia, with an estimated 300 billion barrels beneath its soil, and the vast endowment production has severely declined over decades due to mismanagement, sanctions, and breakdown in PDVSA's operational capacity. So when the US is willing to intervene directly, it tells markets that political risks, not just economic fundamentals, is now a core driver of oil price expectations. From a market perspective, that embeds uncertainty because uncertainty affects risk premiums, investment flows, and the cost of capital. So commodities don't trade on need, supply, and demand schedules during geopolitical shockwaves. They trade on perceived risk, fear of disruption, and repositioning of long-term alliances. This is not to say that oil market will immediately grit to a halt. Okay, in fact, most global analysts believe that short-term supply shocks are limited. OPEC's spare capacity is still helping cushion markets, and Venezuelan output was far below potential even before the event. But the risk premium, the political risk baked into prices, is real. And that risk premium is something financial markets and traders pay for, even if oil continues flowing. This operation is also testing the notion of the US dollar as a safe haven in a very specific way. The currency market is watching not just how oil prices move, but how foreign exchange behaves when geopolitical intervention intercedes with monetary policy cycles in the US, the Eurozone, and China, a dynamic I will unpack later in the slides. Okay, so this level of geopolitical involvement is rare in the modern oil era. It's why we are spending time on it in this webinar. Okay, the market cares not about who controls oil output, but how that control shifts alliances, alters investment flows, and creates new vectors of risk for global markets. Okay, so now let's talk about how the market has reacted since the US operations began. First, okay, oil. Immediately after the news broke, we saw price volatility increase. It wasn't a straight spike that just went up and stayed there. It was a gap and then oscillation. That's important. It suggests markets are reassessing risk rather than just reacting mechanically to a short-term supply shock. You've probably noticed the commodities like Brent and WTI have been trading with a notable geopolitical premium, not necessarily because fundamental supply is suddenly tight, but because investors are uncertain about future production capacity and the political environment around that production. Okay, so the Venezuelan oil sector remains heavily damaged and under invested, meaning any recovery of output would have to be slow and expensive. Second, fixed income. US Treasury yields and credit spreads have been sensitive, especially in the emerging market space. The removal of Maduro and potential disruption to Venezuelan bonds has caused reassessment of risk premium in Latin America foreign debt. Even though spillover to other countries have so far been limited, Morgan Stanley suggests Venezuelan and PDVSA bonds could continue to rally, but other regional bonds are being evaluated for new risk statuses. Third, Forex and safe haven flows. It's been interesting to watch the US dollar and gold, both classic safe havens. Oil volatility often influences the dollar. But right now, there is a tension between geopolitics. Sorry, guys, need to charge my laptop. Okay. Okay, there is a tension between geopolitics risk pushing flow into safe havens and expectations of monetary easing in the US, exerting downward pressure on the dollar. Traders are watching closely whether the dollar strengthens as risk premium increases or weakens as market price future rate cuts. Defense equities also got a boost when geopolitical risk rises suddenly and significantly. Government defense budgets come into focus. Investors start repositioning towards sectors that historically benefit from increased geopolitical spending. The key point here is that markets are responding to uncertainty and potential regime change more than any actual immediate shift in supply demand fundamentals. Prices are not always efficient in the short run. They reflect risk and narratives. That's why it matters so much for macro traders to understand events like this before assuming the direction. Okay, now that we have kind of understand what the immediate actions are, I want to spend a little bit of time to talk about the broader macro context. Okay, so we have talked about markets moving far beyond what fundamentals alone would predict. Venezuela is a prime example of why that happens. Its sheer political complexity and its role as one of the most geopolitical contested energy producers in the world mean that oil and by extension, many correlated markets can trade on political narratives as much as supply and demand. Okay, so later on, we'll kind of unpack how changes in oil supply dynamics feed into forex correlations, how geopolitics with Russia and China change strategic risk, and how emerging markets, both currency and sovereign bonds, react to these types of shocks. Okay. Okay, let's continue with the oil supply dynamic, prices, and forex correlations. Okay, so when traders think about oil, they often think about it in a very narrow terms as a commodity that goes up or down based on supply and demand. But at the macro level, oil is not just another commodity. It is a core input into the global economic system. Oil affects transportation, manufacturing, logistics, agriculture, and consumer prices. When oil prices move in a sustained way, they don't stay isolated in the energy sector. They feed into inflation expectations, corporate margins, household spending power, and eventually central bank policy. Okay, this is why oil prices matter as much for forex, even for currencies that don't directly export or import oil in large quantities. Forex markets are constantly repricing relative growth and relative inflation, and oil sits right at the intersection of those forces. Another important point is that oil prices don't just reflect physical supply and demand, they reflect perceived risk to supply. A barrel of oil that might be disrupted tomorrow is priced differently from a barrel that is guaranteed to be delivered. This is where geopolitics, sanctions, shipping routes, and alliances start to matter just as much as production numbers. So when oil prices rise or fall, forex traders shouldn't ask, is supply tight or loose? They should ask, what does the price move imply about inflation risk, growth risk, and policy response across different economies? That's the lens institutions use, and that's the lens we'll use here. Okay, so let's talk about how oil prices transmits into forex markets, because this is where many traders oversimplify things. The most obvious distinction is between oil exporters and oil importers. For oil exporting countries, higher oil prices can improve trade balances, support government revenues, and strengthen growth, at least initially. Okay, so for oil importing countries, higher oil prices act like a tax. They raise costs, reduce disposable income, and can slow growth. But that's only the first layer. The second layer is inflation. Rising oil prices almost always increase inflation pressure globally, but not evenly. Okay, so country with fuel subsidies, energy self-sufficiency, or strong currencies experience that inflation differently from countries that are more exposed to imported energy. This is why oil prices can strengthen one currency while weakening another, even if both are affected by the same global move. Forex is always relative. And there's the policy layer. If higher oil prices push inflation above target in one country but not another, okay, central banks respond differently. That divergence is policy expectations is in policy expectations is most often where sustained forex trends are born. This is why simple correlations like oil up by X currency work sometimes but fail other times. Correlations are regime dependent. In a growth-driven oil rally, exporters may benefit. In a supply shock oil rally, global growth may slow, risk appetite may fall, and even oil exporters currencies may struggle. So oil forex relationships are not fixed rules. They are conditional relationships. And the condition is that the broader macro environment. Okay, so now we get to the most important and most misunderstood part of the oil forex dynamics. Okay, so what happens when oil prices rise not because demand is strong, but because supply is threatened? In these such situations, oil stops behaving like a growth asset and start behaving like a stress signal. Prices rise, but not because the world is doing better, because something might go wrong. When that happens, correlations can flip. Higher oil prices may coincide with falling equities, rising volatility, and risk of behavior. Forex markets start prioritizing safety, liquidity, and balance sheet strength over export benefits. Okay, this is where traders often get caught. They assume oil exporters will automatically benefit, but the macro environment has shifted. The market is no longer rewarding growth exposure, it's penalizing uncertainty. This is also where oil becomes a regime shifting variable. Okay, a sustained supply shock can change inflation trajectory, force central bank to stay restrictive for longer, and weaken global growth expectations. Forex markets respond not to the oil price itself, but to the second order effects. So key takeaway from this part is simple but powerful. Oil prices matter for Forex not because they move, but because of why they move. Demand-led oil moves and supply-led oil moves have very different implications for currency, risk appetite, and capital flow. And this is exactly why geopolitics, especially involving major energy producers and strategic alliances, plays such a critical role in the macro trading. Okay. Okay, so let's move on to the next part, which is geopolitics with Russia and China, strategic alliances and market risk. So why Russia and China matters in an oil-driven world? Let's find out. To understand why Russia and China matter so much in global markets, especially when we talk about oil, we have to move away from thinking about geopolitics as the new events and start thinking about geopolitics as structure. At the macro level, geopolitics is not about speeches or headlines. It's about who controls resources, who controls routes, and who controls alternatives. Oil sits right at the center of the structure. Russia is one of the world's largest energy producer. China is one of the world's largest energy consumers. Okay, that relationship alone creates a gravitational pull in global markets. But what makes it even more important is both countries view energy not just as an economic input, but as a strategic tool. For Russia, energy exports are a core source of revenue, leverage, and influence. For China, securing stable and diversified energy supply is a national priority tied directly to economic stability and political legitimacy. When these two countries coordinate, formally and informally, markets pay attention, even if the coordination is subtle. What traders often underestimate is that markets don't wait for alliances to be announced. They infer alliances from behavior, from trade flows, from settlement currencies, okay, from infrastructure investments, from long-term contracts. So when geopolitical events affect oil-producing regions, markets immediately start asking deeper questions. Who fills the gap? Who benefits? Who gains leverage? And how do those shifts change long-term risks? Okay, this is why China and Russia sit at the center of geopolitical risk pricing, even when they are not directly involved in the headline event. Okay, so let's talk about something that markets care deeply about but rarely say aloud: flexibility. Markets function best when systems are flexible, when supply can reroute, when capital can move freely, and when stocks can be absorbed by alternatives. Geopolitical alliances, especially rigid ones, reduce that flexibility. When countries align strategically, okay, they often do reduce vulnerability, but in doing that, they also create blocks, and blocks create friction. For example, when energy trade becomes increasingly concentrated within certain geopolitical relationship, the global system becomes less resilient. A disruption in one area can no longer be easily offset elsewhere. Markets respond by pricing higher risk premiums, not because supply is gone today, but because optionality has been reduced. This is why markets often react negatively to deepening geopolitical alignment. Even when it appears orderly, stability in geopolitics does not always mean stability in markets. Sometimes it means less adaptability. Okay, so from a macro perspective, it matters because reduced flexibility amplifies shocks. Oil supply disruptions become more impactful, sanctions becomes more effective, policy mistakes become more costly, and markets, especially bond and forex markets, are forward-looking. They don't wait to see the damage, they price the possibility of damage. This is also why geopolitical risk tends to show up first in volatility and risk premiums, not in immediate economic data. Markets sense that the margin for error is shrinking. So when Russia and China deepen strategic alignments, particularly around energy, trade settlement, or logistics, markets don't necessarily panic, but they become more cautious. They demand compensation for uncertainty, and that compensation shows up in asset prices. Oops, sorry. Oh, sorry. I need to go back. Okay, there you go. Okay, so the final step is understanding how all of this actually shows up in the market, because geopolitics doesn't trade directly, risk does. Markets translate geopolitical uncertainty into price through a few main channels. The first is volatility. When uncertainty rises, volatility becomes more expensive. This affects everything from option pricing to risk limits. The second channel is forex. Currencies markets are often the first to react to geopolitical risk because forex is liquid, fast, and sensitive to capital flow. Investors adjust exposure quickly when uncertainty increases, especially in emerging markets or geopolitically exposed regions. The third channel is bonds. Sovereign bonds, particularly in emerging markets, reprice risk over longer horizons. Yields spreads widen not because default is imminent, but because uncertainty has increased. So what's important to understand is that the markets are not trying to predict outcomes. They are trying to price scenarios. They ask, what if tensions escalate? Okay, what if corporations break down? What if supply routes are disrupted? What if sanctions expand? And the more rigid the political structure becomes, the more difficult it is to absorb surprises. That's when risk premiums rise. So when we talk about Russia and China in the context of oil and global market, we're not talking about ideology. We're talking about systemic fragility. Markets don't fear power, they fear inflexibility. And that's why geopolitical alliances matter so much for macro traders, not because they guarantee disruption, but because they change the distributions of outcome, making extreme scenarios more plausible. That understanding is crucial so that it's easier for you to look at the markets from a different point of view when you're looking at oil. Okay, so let's go into our next topic, which is emerging market spillover, currency, bonds, and risk appetite. Okay, sorry I was talking so fast. I'm obviously trying to catch up with lost time, but it seems like we are doing good with time because I'm down to my last two subtopics and we have about 25 more minutes to go without having to extend the webinar. I'm still going to continue talking a little bit faster because I do want to leave some time for Q&A because I know you guys usually do have questions for me during these webinars. Okay, so let's talk about why emerging markets react first. When geopolitical risk enters the system, whether it's through oil sanctions or strategic alliances, emerging markets are usually where you see the reaction first. Not because the markets are inherently weak, but because they are more exposed to changes in global liquidity and risk appetite. Emerging markets rely heavily on external capital. They depend on global investors being willing to take risk, roll funding, and accept volatility. When uncertainty rises, that willingness changes very quickly. Capital doesn't leave because a country suddenly became less productive overnight. It leaves because investors want flexibility, safety, and liquidity. So this is why emerging market currencies often move before equities and why emerging market bonds often reprice before developed markets bonds. Forex is fast, bonds are sensitive, and both are directly exposed to shifts in confidence. Another important point is that emerging markets don't need to be directly involved in a geopolitical event to be affected by it. Spillovers don't travel through geography, they travel through balance sheets. So if oil prices rise, inflation expectations change. If risk premiums rise, funding costs change, and those changes disproportionately affects economies with less policy flexibility. So when global risk shifts, emerging markets assets become the release valve. Markets don't ask whether it's fair, they ask where the exposure can be reduced most easily. Okay, I mean, we slow down and look at how the transmission actually works, because this is where macro traders gain the edge, honestly. Okay, when oil prices rise due to geopolitical risk, emerging markets are affected through several channels at once. For oil importing emerging markets, higher oil prices worsen trade balances, push inflation higher, and reduce household purchasing power. That creates pressure on currencies and forces central banks into uncomfortable policy decisions. For oil exporting emerging markets, countries, the effect can initially look positive. Export revenues rise, fiscal balances improve, and currencies may strengthen, but that benefit is often conditional. So if oil prices rise because of global stress rather than strong demand, the positive effect can be offset by falling risk appetite and tighter financial conditions. This is why emerging market forex often reacts first and most visibly. Currency markets can adjust instantly. Okay, policy cannot. Bond markets sit anywhere in between. They reflect longer-term confidence in fiscal sustainability, policy credibility, and access to capital. Geopolitical uncertainty adds another layer. Investors start asking questions that have nothing to do with near-term growth numbers. Can this country fund itself if conditions tighten? Does it have reserves? Does it have policy space? Does it rely on friendly or hostile trade partners? These questions don't get answered overnight, but markets don't wait for answers. They price risk asymmetrically. And that's why you often see emerging market bond spreads widen even when there's no immediate economic shock. The bond market is pricing the possibility that conditions could deteriorate, not the certainty that they will. Okay. And one of the hardest things for traders to accept is that spillovers are rarely logical. Markets don't pause to evaluate which emerging markets are safe and which are not. In periods of stress, correlations rise, nuance disappear, and assets move together. This is not because investors suddenly believe all emerging markets are the same. It's because liquidity behavior dominates analysis. Where risk appetite falls, investors reduce exposure where they can, not where they should. This is why contagion often feels unfair. Countries with strong fundamentals can see their currencies weaken and their bond spreads widen simply because they sit in the same asset class bucket as more fragile peers. From an institutional perspective, this is not a flaw in the system. It is a constraint. Risk limits are often set by asset class, not by country narrative. So when volatility rises, exposure is reduced broadly. This is also why emerging markets um, markets can overshoot in both directions. When liquidity is abundant and risk appetite is strong, capital floods in and compresses spreads beyond what fundamentals justify. When liquidity tightens, the same capital exits quickly and spreads widen aggressively. So for macro traders, the key is not trying to argue with contagion, but recognizing when it is likely to appear. Rising geopolitical uncertainty, higher oil prices driven by supply risk, tightening global financial conditions, these are environments where emerging market assets tend to behave less independently. And once you see the pattern enough times, you stop being surprised by it. You stop asking why it's happening. You start asking how exposed you want to be when it does. That mindset shift alone can save traders a lot of frustration. Okay, so let's move on to the last part of our webinar, which is the long-term scenarios, regime change, energy flows, and global supply chains. Okay, so thinking in scenarios, not outcome. Okay, when we talk about long-term scenarios, the first thing I want to emphasize is that markets do not move based on a single clean outcome. They move based on a range of possible futures, each with a different probability attached to it. This is where many traders get uncomfortable because, the thing about us, right, humans, we want clarity. Okay, we want to know what will happen. We want to know if there will be regime change. We want to know if there will be if energy flows will normalize, will supply chains stabilize. But markets are not in the business of certainty. They are in the business of pricing uncertainty. At the macro level, long-term shifts rarely arrive at sudden events. They arrive as slow changes in incentives, behaviors, and structure. So capital adjusts gradually, companies adapt cautiously, and governments respond imperfectly. And the markets constantly update their expectations as a new information arrives. So instead of asking what will happen, the more useful question is what kinds of futures are now more likely than they were before. The mindset matters because it changes how you interpret price action. You stop reacting to every headline as if it resets the world. You start seeing markets as slowly re-weighting possibilities, sometimes unevenly, sometimes emotionally, but rarely, very, very rarely, randomly. Okay, so one of the most important long-term changes the markets are grappling with is the idea that global supply chains are no longer optimized purely for efficiency. For decades, the dominant assumption was that the cheapest and fastest route would always win. Okay, I mean, that's very logical. I don't see why that doesn't make sense, right? Okay, energy would flow whenever it was most efficiently produced. Goods would be manufactured wherever labor was cheapest, and capital would move wherever returns were highest. Okay, that totally makes sense. Um, right? You just go whichever which is the most cost efficient. So that assumption right now, honestly, although it makes sense, it makes so much logical sense, is being challenged. Okay. Today, energy flows are increasingly shaped by political alignment, strategic trust, and security concerns. Okay. Countries care not just about price, but about reliability. They care about who controls production, who controls transit routes, and who controls payment systems. This doesn't mean globalization disappears. It means it becomes more fragmented. Supply chains become more regional. Redundancy becomes valuable. Resilience becomes a feature, not a cost. So, from a market perspective, this matters because fragmentation tends to increase baseline volatility. When systems are less centralized, shocks are absorbed differently. Prices adjust more frequently, risk premiums become stickier. This is not necessarily bearish or bullish in isolation. It's simply a different operating environment, one where long-term assumptions are less stable and where macro narratives evolved more slowly but with greater persistence. Okay, so as we think about the long term, it's useful to step back and ask a very simple question, okay, which is what do markets ultimately reward? Okay, what do the markets ultimately reward? And that is important. It's a very important question to ponder on because it is the question that will bring you to the winning setups, the winning trades, the winning make you profitable. Okay, so over time, markets reward stability, credibility, and adaptability, not perfection, not moral alignment, not even growth as at all costs. They reward systems that can absorb shocks without breaking. This is why regime change, energy realignment, and supply chain reconstructuring are not judged instantly. Markets markets watch how countries behave under pressure. They watch how policy framework hold up. They watch whether institutions respond consistently or erratically. Capital is patient, but it is also selective. Okay, I see your questions coming in. I'm glad you have questions coming in because we would have about 10 more minutes left. I was speaking a bit too fast the first part of the webinar because I was obviously trying to make out of lost time. But yeah, we are well into finishing the webinar on time, even though the first part I was using it to make sure everything was working fine. Yes, I see your questions. I will answer it in a bit. I'm almost done with this slide and then we can move on. Okay. Okay, so that's a very different way of thinking about the markets. It's slower, it's less emotional, it's much more closer to how large pools of capital actually operate. And if there's a quiet takeaway from this entire final section, okay, it is this, okay? Markets don't move because the future becomes clear. They move because the balance of uncertainty shifts, right? There's always uncertainty in the market. It's just that it's constantly shifting. Okay, so if you can learn to observe that shift without needing certainty, you're already thinking in a way that most participants never quite reach. Okay. And you're already thinking in a way that most, I would say, half Forex traders, half the traders out there won't reach. Because I mean, let's be very honest. I think 80% of like retail traders, I'm talking about you and I, who like we open an account with a broker, we put in our own money and then we trade. Okay, half of these people, or maybe more than half, I would say a very, very high percentage of these people, honestly are using just technical analysis to trade, right? I mean, even I've been trading for so many years. I've only recently started adding fundamental analysis, news trading, geopolitics, all this eventful stuff into my trading. And this is like as recent as just like last year when I started taking you guys for these webinars and I was given the task to research about these topics for you guys. And that's when I started combining fundamentals into my trading. And my trading has just become so much more profitable than it used to be, right? I was already profitable before, but sometimes when I lose in the past, I don't know why I was losing, right? It wasn't clear to me that I was losing. Sometimes when there's a trend reversal, it's not clear to me why there's a trend reversal because I'm not combining all this macro and microeconomic stuff into my trading. And now that I am, and now that you are here every week attending these webinars and absorbing all this information, you would already be thinking way, way, way higher or way more in depth than all the other traders. Okay, so I see some questions coming in already. I see the last one is so funny. Uh, Next, Jeffrey Epstein topic. How is it affecting trading in crypto? Affecting trading? That is a very good question. I actually don't know how the Jeffrey Epstein topic is affecting the markets because I have not actually looked at that topic in a financial point of view. I see it a lot on social media, right? I see it's horrible. It's so horrible. I don't know why there are humans out there like that. This is why having a religion is so important because religion stops you from doing stuff like that, I think. I think at a very least, all religions will stop you from doing crazy things like that. Like, how do you do all of that? Yeah, but sorry, I wouldn't be able to answer you, Helen. But yes, that is something that I should research on, and maybe let me see. Maybe that is a topic that I can do next month. Um, I actually already sent in my topics for next month. Okay, I will do a Jeffrey Epstein topic in April, even if there is even something to talk about. Because let's face it, I don't even know if the Jeffrey Epstein topic is even affecting the markets, but I will research into it, and then if there is any effect at all, I will do one of that topic in April. I can't do it next month. I already submitted all my topics for next month, so I'll do it in April. Okay. Okay, so another question here is Venezuela actually big enough to matter to global markets, or is it just being overhyped? Um, Very good question. Rob. Oh, hello, Rob. I actually don't see you often in this webinar. I see you once in a while, but hello, welcome back. Okay, so on its own, Venezuela isn't moving the markets because of current production levels, okay? Um, those are still relatively low. Okay, what matters is potential and the uncertainty, right? Like I said, the markets are less pricing in things before it actually happens. So Venezuela has enormous reserves and any change in control. So sanctions or assess introduces long-term questions about supply, alliances, and pricing power. The markets tend to price that uncertainty early. So even if the actual barrels don't hit the market for years, yeah, it might get priced in very, very early. Okay, I see another question. I mean, there's a few questions coming in. If oil supply isn't immediately disrupted, why do the prices still react? Okay, good question. Because the markets don't only price today's supply, right? They are always pricing the future risk. So it's always about what the markets are expecting, right? So a lot of times it's like reacting based on expectations. So oil reacts not just to what is happening, but to what could happen if conditions change. So that's the thing about geopolitics. Okay, so geopolitical events introduce uncertainty around production, shipping, sanctions, and investments. Even if supply stays stable for now, the risk premium increases, and that shows up in price and volatility. Why do emerging markets currency react? That doesn't make sense because they're not even involved at all. Okay. So because capital flows don't move country by country, they move in like risk baskets, right? Or risk buckets, right? So when global risk appetite changes, investors reduce or they increase exposure across the entire asset classes. So emerging markets tend to be more sensitive to that shift because they rely more on external funding. Okay, it's very little to do about fairness and a lot more to do about liquidity and flexibility. This is a very good question. How do I know if the oil move is about growth or about fear? Okay, so you usually see it in how the markets behave alongside oil. If oil rises and equities are strong, credit spreads are tight, and the risk currencies are doing well, that's more of growth driven. If oil rises while equities struggle or is not doing well, okay, volatility increases and safe haven catch a bit, that's usually fear driven. So the context matters more than the oil price itself. Okay. One more, I see another question. So why do markets sometimes seem to overreact? Why do markets sometimes seem to overreact? Okay, I'm assuming you're saying overreact to geopolitical news. Is that what you're asking? Okay, cool. Okay, so the markets again are not reacting to the headline. They're reacting to uncertainty. It's always about uncertainty, right? Okay, so headline or whatever it is, compress complex scenarios into one single simple story. And during uncertain periods, participants reduce exposure quickly. That can make moves look exaggerated in hindsight, but at the time, markets are they're kind of prioritizing protection over precision. Okay. So I won't say it's overreacting. I would say it just looks exaggerated. Okay. Okay, another good question. How long do this geopolitical news affect last in the market? Okay, that's a very good question. Okay, it varies. Again, context is important. The initial reaction is often fast and emotional. Okay, it's very dramatic, but the longer term impact depends on whether the events changes structure. Okay, so we're talking about things like uh, supply routes, alliances, or policy direction. If nothing structural changes, markets often fade the move. Okay, if something structural does change, the effect can persist quietly for a long time. What is the biggest mistake traders make when trading? Um, What is the biggest mistake traders make when trading? Whoa, that is a very big question. Okay, I'm going to narrow down this based on today's topic. Okay, so uh, what does the biggest traders make when trading geopolitics? Okay, let's talk about geopolitics a little bit more relevant to today's topic. Okay, because that question is really huge. Like that's too wide and vague. Okay, because if you say what's the biggest mistake traders make when trading, there's so many. There's risk management, um, over leverage. There's so many things. Psychology, right? Trading psychology and whatnot. Okay, but about geopolitics, okay, I would say the mistake is treating geopolitics like a directional signal instead of a modifier. Okay, okay, so traders either overreact or chase the headlines, right? Or they dismiss geopolitics entirely because that's what technical traders do, because it feels unpredictable. So the more useful approach is to recognize how it changes volatility, correlations, and downside risk, and adjust your behavior accordingly. Okay? Yeah, so if you guys have any more questions, ask me in the chat box. I've got like, I mean, we've kind of overshot time already, but I don't mind staying for another like 3 more minutes if you guys have a question. Yeah, ask away if you guys have any more questions. What's our topic for next week? Oh, very good question. I actually don't remember. I'm so sorry. I have it all on a schedule. It's not on this computer. I don't remember it on hand because I have so many webinars. I have so many like work in my schedule, so I don't specifically remember what is for you guys next week. But it is like I said, every week I'm gonna take you guys for one either macro, microeconomic, and geopolitical um topic. Okay, that will help you see the markets from a different perspective, right? It's nothing to do with technical analysis because I used to do technical analysis for you guys, I think about last year, and Vantage have requested that I do fundamentals instead of instead of technical analysis, so that you guys can see from a different perspective as well. Because I mean, let's be honest, technical analysis is everywhere, right? Every trader wants to act cool and look cool by being able to draw on a chart, but actually the hard part is sitting down and understanding the information on the news, um, the data, the economic data that is happening in the markets. Okay, so I don't know what I'm doing for you guys next week, but it's definitely going to be something fundamentals related, nothing to do with technical analysis. Okay, so yeah, that's all I have for you guys this week. I will catch you guys next week. Bye everyone, take care. I think I was just checking Vantage app and it seems like we got disconnected early, but yeah, hopefully you guys catch the most of it. Okay, bye everyone, take care, see you guys in a week.